Money Show.
Personal Finance with Warren Ingram.
And a reminder, of course, Warren Ingram is a certified financial planner at Galileo Capital. I don't know if you really want to look at the calendar and see where we are in the year, because we're actually just past the halfway mark. The winter solstice, thank goodness, was already 2 weeks ago. And so we're kind of heading straight for December and hopefully a little bit of warmth. Time for a mid-year financial check. Warren, good evening. I feel a bit like I'm at the doctor, actually, and you're about to hit my elbow with a hammer, kind of. What exactly do we need to look at when we start with our check? And you first suggest we look at our emergency fund.
Yeah, and it's never a bad thing, Stephen, to know your position. I mean, if you start the year and you're bright-eyed and bushy-tailed and you make some plans for the year ahead, hopefully, plans that are meaningful to you, then at some point along the way, you should say to yourself, how am I doing and where am I going and am I on track? And if you're not, what am I going to do about it? All good things to do. And so, yes, this is the doctor's room for your money for the 6 monthly checkup. And the emergency fund for me is in a time of, I would guess now after Trump's announcements, even more uncertainty than before. The emergency fund is the one antidote we all have to this kind of uncertainty that could impact us. I think about people in the farming industry now, especially if you're in citrus, you're probably very worried. And so in a situation like that, having an emergency fund is your protection. It's impossible for people to kind of protect their earnings forever, for their entire career. I think that's a very difficult thing to do. But certainly buying some peace of mind with your emergency fund, I think is something we can aim for. And so the starting point here is, we've said it on the show before, you need somewhere around 3 to 6 months worth of your expenses in an emergency fund. And I think it's the fundamental aspect of all of our financial planning if we want to get to a point of freedom somewhere along the line. And so that's step one. Have you got 3 months? If you have, well done. If you've got 6 months, even better. And then don't worry about it. You can move on to step 2. However, you might be in a position where you don't have that. And then I would say, well, if we're in a situation where you've got an ideal range, which is 3 to 6, what's the real red flag? Where should you be worried? And to me, the real red flag is if you've got less than 1 month's worth of expenses in an emergency fund, in money that's available to look after you, at very short notice for things that are not planned for real emergencies. So I think step one is let's check that emergency fund and make sure that we've got enough money. If we don't, and you've got less than a month, then I think you need to take some serious action as soon as possible to at least get to that 1 month's worth of expenses now and get it set aside just to protect you against things you cannot foresee.
I suppose that really is, if you can't cover things for a month, you are in a difficult position. Okay, then a debt to income ratio. This is about how much money you get every month and then watching the SMSs go out.
Yeah, and it's actually, it's something that we monitor when we talk about countries and, what's their debt versus the size of the economy. And we look at companies and we worry about how much debt are companies funding from the income that they're generating. And I think it's a very interesting ratio to work out for ourselves. So it's a very quick math lesson, but if you take what you spend in a month on debt, so how much does it cost you to repay your debt every month? And you divide that by your total salary, in other words, the salary before all the deductions and taxes get taken off, and you multiply that by 100, you get to a percentage. So just for example, let's say you earn 10,000 Rand a month and you're spending 1,000 Rand a month on paying off your credit card, and that's the only debt that you've got. So you would take the 1,000 Rand a month, you divide it by 10,000, which is your salary, and you get to a number, and I believe it's 0.1, and then you times it by 100, and that gets you to a number of 10, and that tells you that your debt to income ratio is 10%. And for a business, a person, and possibly a country, that's an extremely healthy ratio. We obviously don't really want a lot of debt in our lives, but I would suggest that if you're spending 30% or less of your total salary on debt repayments on a monthly basis, you're okay. You're not in a great position, but you're okay. That's not a red flag for me. But if you go over 30% and you get closer to 40%, then you need to know you're in a danger zone, because taxes are probably 30%, and then you're paying 40% of your income to debt, which means you don't have a lot of money left over for food, entertainment, school fees, rent, and all of those things. So I would say that's a good ratio to work out for yourself now. It might be scary. The thing about bad news is it's probably always worse when we don't know the real story. And so we put it off and we don't want to look at it. But my suggestion is this is the time. This is where you look at it, you kind of write that ugly number down, and then you work out a game plan for what you do to start getting your debt down, because you've got a few months, nearly 6 months left of the year to go, and you don't want this problem to get bigger and bigger, and by the end of the year you're really grappling with an enormous problem that's compounding against you. So it is the half-year health check. Take time to look at this number, and then take some steps to get that debt repayment down again. And if you've got to make some tough decisions, make them now before they become much bigger and much tougher problems to deal with.
Okay, so 30%, up until 30% of your monthly expenses going to debt, that's okay. But 40% or more, you need to take action.
Yeah, and it's one of those things where you need to get on the front foot. What you don't want to do is be in a position where, the bank comes knocking and takes your car because you can't afford the debt repayment. What they'll do with that car is they'll put it on auction, and I promise you that price is not going to be as good as the price you can get if you take control and sell that car yourself. So that might be a radical step that you have to take. And for some people, we read horror stories about their houses being taken by the banks. Obviously, there's a long process, but they lose the house. The house gets auctioned for terrible value. If you're in that kind of a position where the debt is growing from 40 to 50 to 60% of your total salary, you need to take serious action now and get ahead of this, because you want to sell your assets so that you get the best price, that you get this debt down and take some control. Don't let the banks and your creditors take control. They don't have your best interest in heart. They want to pay off the debt and get the money back that they are owed. That's their concern.
And then looking at your savings rate over the last 6 months, what kind of questions would you need to ask yourself?
So I think, look through what you've earned over the last 6 months. That's not that difficult to go through on your banking profile, and then see how much of that money have you actually saved. We'll tell you, often that you should be saving kind of, at the minimum, somewhere around 10 to 15% of your salary on a monthly or yearly basis. So we're 6 months into the year. You've seen what your payslip was like in June, so you've got all the data you need for the first 6 months, and work it out, and see, if you're earning back to the 100,000 rand. Let's say you've earned 100,000 over the year. Have you saved at least 10,000 to 15,000 of that for long-term savings? That's part of your kind of deposit for a house money and your retirement money and your financial freedom money. If you have, then you're doing the minimum, which is good. I mean, well done. You've achieved something so far for the year. If you haven't achieved that, it's important to kind of sit down and work it out. What went wrong? If you started the year saying, I think I can save 10 to 15%, what's derailed the plan? And more importantly, how can you prevent that from derailing you for the next 6 months? And what sort of action can you take to make sure you play a little bit of catch up? And I think that's, again, it's something where we can make a small change now and a little bit of an adjustment, make up for some lost time, and hopefully end the year achieving that savings goal. You didn't set that goal for fun. You set that goal because you want to get to financial freedom.
Also this time of year, maybe it's just me. I've started to think about the end of the year, holidays, things like that. What's going to happen? Will there be one? You need to plan for things like that too, or even to determine if you're actually going to be able to go away.
Yeah, and let's say that you do get leave over December. The good point now is you can look at what's gone on in your finances. You can understand your financial position, and then plan the holiday according to the income and expenses that you have today. So I think a lot of the time people don't plan at all, and they don't actually make the bookings and all of those things. So they get to October, November, and then they start planning frantically to try and find somewhere to go. And obviously by then, what's left is either garbage or super expensive. And so planning now means that hopefully you get some access to places, but equally that you can go to places that actually suit the budget that you have rather than the lifestyle you think you should be living. So, if money's tight, then, where can you go camping? If money's tight, can you go and stay with friends on a countryside house or, on a farm or something like that? You don't have to go and live large, in the waterfront and, compete with all the foreign tourists and their huge budgets. You can do things that are fun, that aren't that expensive, but you can't do those things if you don't plan for them. And planning starts now, and figuring out, how much money you can set aside on a monthly basis for those holidays, so that you don't start in January again with debt and on the back foot before you've even got going.
It's a fascinating question. We've got a question from KG saying, "Hi guys, I haven't heard from my financial advisor for 2 years. I see from my statements that they're still earning a fee from my investments. Is this correct?" We'll find out from Warren Ingram in just a moment.
The Money Show. Personal Finance with Warren Ingram.
And we had a question from KG Warren saying, "Hi guys, I haven't heard from my financial advisor for 2 years. I see from my statements he's still earning a fee from my investments. Is this correct?" And KG reminds us how carefully you need to check your statements, Warren.
Gee, this question is making my blood boil. The answer, KG, is that it's absolutely wrong. It's wrong from a moral point of view, it's wrong from an ethical point of view, and it's actually against the law. So the law that that applies here is around something called the Phase Act, and we don't have to go into all the detail. But at an absolute minimum, if you've got a financial advisor who is looking after your investments and earning a monthly fee from them, this could apply to investments, but equally to life assurance and all of those things. If you've got an ongoing relationship, they have to correspond with you. So they have to send you at a minimum something in writing which explains that your investments or your products are still going. What are the obligations that you've got? If you've got debit orders, what are the values? What are the benefits? All of that information, and then any fees that they are earning. And if you're not getting that as an absolute minimum, then what's happened is they have just done a transaction with you. They're earning fees, and you're getting no service. And actually, I would say if it's investments, they're going backwards as well. So there is no way that that's correct. I would report this person straight to the Phase Ombud if I were you, because they know their obligation. This is not a new thing, and certainly not going to be a surprise. But it happens quite a lot in the industry, Stephen, where advisors take on probably 150 or 300, sometimes up to 500 or 600 clients, and there is no way that you can have a proper one-on-one relationship with that many people as an advisor looking after clients. They're not clients; they're just transactions that you've done. So I think for KG, this is really bad news, and we should hold advisors to account. It's great that they get paid for delivering good service, but when they're getting paid for doing nothing, for having sold you a product some time ago, then you should take them on. You should call them out. And if you don't want to report them, then make contact with the product provider and tell them that you are firing your advisor and you don't want to be charged a fee at all for advice.
And they have to listen to that, do they? The people who you're getting the product from, the big providers.
Absolutely. They have no choice. You're not obliged to deal with an advisor in a situation like this. If they refuse, what that means is they're enabling an advisor to continue breaking the law. So they must listen to you. And in fact, to give credit here, some of the product providers would be horrified and actually would blacklist those advisors as well. If this is something that an advisor is doing, as part of their business practice, a lot of the product providers would want to know about it so that they blacklist that advisor and they don't get associated with this.
Okay. Investment performance. So let's just go back to the sort of 6-month health check, the mid-year health check that we're doing here, and sort of tapping my knee with the hammer. The investment performance, we actually need to look at how your investments are doing, because this is the other thing. You've invested money. There's no point having money that's not performing for you.
Well, I think it's number one. What my first comment will be, let's say you've bought a unit trust that invests in the South African stock market. One of the things you would like to do now is to check what is your investment done. You've got 6 months of history. So how has it performed? And then the other thing to do is compare that to the performance of the all share index, the South African stock market for the last 6 months. And that's information that you can find pretty easily on the internet. It's not hidden. You don't have to pay for it. But for interest, I mean, from the 1st of January to the end of June, the South African market's given a bit more than 16% for the first 6 months of the year. So what you want to do with your investment is, if you're in a pure stock market index, unit trust or exchange traded fund or whatever it is, and your investment has done roughly that amount, it doesn't have to track it exactly. So if it's done 14% or it's done 18%, somewhere around there, then what you do know is it's doing its job. It might not be doing it perfectly, but investment is not an exact science. So then you could say to yourself, it's doing okay. And similarly, if you've got a global investment, understanding what the global markets have done and how has your investment performed relative to that. And so you would go across the board. If you've got a balanced fund, balanced funds would have a lot of exposure to shares, but that also have exposure to bonds and cash and property. And for the first 6 months, all of those assets have made money. So if you're in a position where you've got a balanced fund that's lost you money, and all the other aspects of the markets have gone up, it tells you that you've got something that's gone wrong. And then you need to do some real homework to understand, why is your balanced fund not doing well when all the underlying components of those markets have done well? So I think it's, equally, if we were sitting here and the global markets were down for the year, the JSE was down for the year, and maybe the bond market as well, and your portfolio was down by a similar amount, then you understand the tide has gone out, your investment is down. That's the unfortunate part about investing. You will lose money from time to time. So it's about understanding the environment in which your money is working, and then how is it performing relative to that environment. And at the moment, things are going well. Despite all the bad news and despite all the drama around the world, markets are performing well, especially in South Africa. So it should be a rewarding time. You should be looking at positive statements now, and if you're not, then you need to ask some serious questions.
It's very tempting at this point to sort of compare yourself. Personal finance advisor said, do this, and this is how much money they've made, and I've only made that much. I mean, should you be comparing with other people?
No, I mean, I think, understanding that when you've set your goals, your goals are determined by your appetite for risk, your financial position, your time horizon. So there's so much that's unique to you. And comparing what you've done to the person next door, you might well be comparing, an apple to, a roast pork, just so completely different. And then expecting, a good outcome if you then adapt your investments to what your friend has done, where they might have a totally different position and risk tolerance. So I think it's much more important to compare your investments to their own universe, what they're supposed to be doing, and then knowing that you're on track or not relative to yourself. You're not in a race with anybody. Your job is to set your own objectives and then reach those. And I think a lot of the time people make the mistake of comparison. They look at what the world has done or what the markets have done, forgetting, for example, that they can't tolerate losses. So if you can't tolerate losses and you see, well, the JSE's gone up 16% for the last 6 months, and suddenly you swing all your money into the JSE, and then it promptly loses you 16% over the next 6 months, you're only compounding really bad mistakes on yourself. So the comparison game in the investment world is really a bad way to make long-term decisions, and you should really avoid it.
And very quickly, the rand also has an impact, right?
Yeah, I think, understanding now that, a lot of our balanced funds, for example, can allocate 45% of their assets overseas. So when we've watched the rand go from 19 to the dollar all the way down to 17.50 or nearly 18, it does have an impact. It will mute the returns that you're getting, but understand that cycle will turn again. So just know that the rand is now a factor in a lot of our retirement funds and a lot of our balanced funds, much more so than it was 5 or 10 years ago. So just be aware of that when judging the performance of your investments.
Warren Ingram, thanks so much. Co-founder of Galileo Capital and a good doctor to speak to for your financial health at this time of the year.